It's time for FT Lex. We partner with the Financial Times to bring you Lex on Bloomberg so you can get a sneak peek at the FT's flagship column. A day early, Sarah O'Connor is with us from London. Sarah, you're taking a look at France. France has some things in common with the rest of Southern Europe, does it not?
Yeah, that's true. I think often investors will sort of lump France in with those other big AAA-rated northern European countries like Germany. But actually, France does have some things in common with those more troubled southern European countries. The main thing is that it's quite indebted, about 80% of GDP now. And so, yeah, there is a certain concern that actually, it has more in common with those countries than we thought.
Okay, well, Sarah, the only thing that really matters at the end of the day, though, is whether or not France is able to service its debt. Is there any reason for us to be concerned that France is going to join the ranks of, say, Spain, Portugal, Italy, perhaps, as a country where investors have concerns debt refinancing will be problematic?
No, not really. I mean, interestingly, today there was a survey that came out that said that the French people think that their country might default in the next 10 years. I mean, I don't think that's plausible. There's no sign that France has any trouble refinancing its debt, even though there's a lot of it. Spreads over bonds are about 30 basis points. That's very low. I mean, a quarter of what Portugal has to pay to borrow. So, no, there isn't really any concerns about that. And also, France is promising to reduce its budget deficit to make some austerity measures in the same way that Southern Europe is also promised.
Promises to reduce the budget deficit. Should we have any more confidence in what France is saying than perhaps we have confidence in what Spain, Portugal, and the rest are saying?
Well, not necessarily. France hasn't actually managed to have a budget surplus in the last 30 years. And also there were figures that came out last week which were a bit worrying on that front. French GDP actually only grew by 0.1% in the first quarter of the year. And if you took out exports, then in fact the economy would have contracted. So it's quite a weak economy, and you can see why President Nicolas Sarkozy might want to wait a little bit before he tries to introduce some of those cuts. But I think that the danger in that really is not so much for France, but for the signal that that might send to Southern Europe. We've already seen a lot of unrest in places like Greece. People aren't happy with these cuts to their lifestyle that they're having to experience. And if they then look up to their neighbour and see that France, its big and powerful country in the centre of the Eurozone, isn't having to play by the same rules, and that could be quite difficult for the cohesion of the Eurozone as a whole.
We'll have to see how it plays out. Sarah O'Connor, thanks so much. That is Sarah at the FT's Lex desk in London.